Mahesh Nandurkar, Head of Research and MD at Jefferies India's Radar. Mahesh, welcome to the show and always a pleasure to speak to you as well on NDTV Profit. This is Hiral on this side. My question coming to you is, the setup in terms of markets is kind of choppy. There is that little bit of positive momentum. The derailment also happens pretty quickly. And the way we saw markets spike in trade yesterday on the commentary coming in, that there is a potential conversation happening tomorrow when you talk about the trade deal between India and US, there was that little bit of excitement that did come in as well. If you have to look at 2026 as a year from here on, what is your read when you talk about earnings, valuations, geopolitical crisis, etc.?
Thanks, Cyril, first of all, for having me here. And it's always a pleasure to be talking on this channel. So going into 2026, you spoke about various things, including trade deal and, generally the broader outlook. I believe that the market at this point in time, looking ahead into 2026, clearly lacks big sort of themes, as such. And we believe that this is clearly a much more bottom-up market. We have to look at individual stocks, maybe some subsectors which are looking interesting, but not too many very, very broad themes. I mean, you did mention like a trade deal, but we've been talking about it for nearly 6-7 months now. Let's hope that it happens sooner rather than later. But my sense is that the focus should be still on individual, ideas. And what is really interesting to see is that while the headline index, Nifty, was up nearly 10-11% last year, but if you look at the composition of any broad-based index such as Nifty 500, nearly 275 stocks have actually delivered negative returns out of the 500. And even among the stocks that we cover, and we cover about 250 stocks, nearly 40 stocks have corrected by more than 20%. So we believe that a lot of this stock correction on one side was probably fair and expected given the high valuation that we started the year with. But then there are some subsectors and some stocks where we think that the valuation has overcorrected and provides you with that interesting bottom-up ideas.
It's great talking to you as always, and we love having you more than you love talking to us, I can assure you that. So good morning to you and a happy 2026.
Good morning, Neeraj. Happy 26 as well.
Thank you. I wonder, Mahesh, I just taking a leaf out of your opening answer, that all things put together, even if the trade deal were not to happen or happens with a bit of a delay, would it still be a happy 2026 because of a number of other factors, as you enumerated, relative valuations, earnings come back, etc., etc.?
Yeah, so the thing is, we believe that the broader market, in 2026 will probably unlikely to give very strong returns.
Okay.
So we are looking at still maybe like a high single-digit type of return, not very different from what we saw last year. Because what we've seen is that while the market delivered about 10-11% returns last year, the FY26 earnings growth has actually been in single digits. So it's not that the valuations have really corrected, as such. One can argue that the valuations have corrected in the relative sense and relative to the other Asian markets, because the Chinese market, the Taiwan, Korea did exceedingly well last year, almost up like 25-30%, some even more than that in US dollar terms. So yeah, maybe to that extent, the valuation correction has happened on a relative basis, but not on an absolute basis. And now going into CY26 or FY27, the good thing is that we are expecting the corporate sector earnings growth to recover, helped by a couple of factors like, one, hopefully the nominal GDP growth improves this year. When I say this year, I mean FY27. FY26 nominal GDP growth was 8.5, or, is likely to be 8.5. Next year, we hope it will be 100-150 basis point higher. So that should be a broader positive for overall revenue growth and EPS growth. The second is that we believe that the worst in terms of the banking sector earnings revisions on the downside is behind. Maybe there could be some small revisions still remaining because we saw one rate cut just a couple of months back, and possibility of one more rate cut exists. So maybe that's a bit of a negative. But the third thing and the most important thing from sector and stock selection point of view is the fact that last year in CY26, we had excessive monsoon and extended monsoon season, which is great for the broader economy. But when you look at the stocks that are listed and for the corporate sector that we track, many sectors that get negatively impacted and many stocks get negatively impacted. And assuming that it's going to be a normal monsoon this year, many of those stocks can actually bounce back reasonably well this year.
Okay. Uh, Mahesh, the early signs of earnings isn't exactly bad. There's just one small, how do I say, not an issue, but a matter that caught everybody's eye, especially with the TCS numbers, was the provision that they made for the new labor laws, right? I don't think there is too much of clarity around there, but you guys have written something on it. I would love to know how you have analyzed the labor law provisions that companies may have to make or will make, and the actual impact on their numbers through 2026.
Sure. Thanks, Neeraj. So, as you rightly mentioned, we still don't have full clarity on what exactly is likely to happen, but we do have some indications. Some companies have reported, and we've been speaking to some of the experts in this area as well. So, I think what it looks like is that the definition of basic pay, right, has been revised to at least 50% of the CTC. And in many organizations, that number is actually lower than that. So once you revise upwards the basic pay, the provident fund and the other associated things, and also there are some changes in the gratuity calculation and the leave encashment, etc. as well. So some of that will be one-time impact, which will be seen in the December quarter numbers. I think the market will likely ignore that because that will be one time, mostly for gratuity and leave encashment, etc. But the more recurring impact for FY27 and FY28 will be in the form of the definition of the basic pay and the way it impacts your provident fund, and especially the employees which are earning relatively less, so some of the younger employees if the basic pay goes up and the provident fund contribution goes up, then the take hand, goes down, and the companies will need to kind of restore that in many cases. In case of like senior employees, maybe they have the capacity to absorb, and maybe some readjustment can happen, and that should be okay. And a little bit of tinkering on the sort of take home pay is fine, but it's mostly at the junior level where there will need to be incremental provisions or incremental employee expenses that the companies will need to provide. We've taken a ballpark number that likely impact of this is going to be about 2% on the wage cost for FY27, FY28 on the recurring basis. And essentially, that is going to be negative for companies that have a higher ratio of staff cost to PBT, because then it means that every 1% increase in the staff cost impacts your profitability a little bit more.
Interesting. So, Mahesh, I'm wondering, we'll go through the note, but I'm presuming you would have done some research as well. So we'll probably try and dig those names out too. But just one quick follow-up there. Isn't it counterintuitive at a point of time when you're trying to do everything that you can to enhance consumption spends, that you are doing this, which may reduce the take home for the start of the pyramid labor force?
Yeah, so that's what I feel. As I mentioned, that while the law effectively implies what you just said, but I think the companies will need to make amendments to their wage structures, and maybe upwardly revise the pay scales for the June level. So that's what we expect. So when I said that there will be a negative impact on some of the companies, I'm assuming that those companies will end up raising the pay scale so that the take home pay does not go down.
Mahesh, you're talking about take home pay does not go down is what you're looking at, but any specific sectors that you're watching out for where the potential of an impact could be higher and it could be recurring as well, which now, everyone needs to bake it in terms of their expectations?
Yeah, so I can't talk about individual stocks here, but we have highlighted a few sectors or a few subsectors. I mean, especially if you look at some of the e-commerce names or some of the quick commerce names, where there is a large staff that they employ, and the ratio of the staff cost to the PBT is actually quite high. There could be some impact. There would be some impact on the IT companies, also on the negative side. So I mean, one really needs to look at it on a company by company basis. But these are some of the subsectors: quick commerce, e-commerce, IT services. There are, one or two banks as well that get negatively impacted also.
Regards to where the new labor codes go, shifting focus in terms of what's in store when you talk for markets as well. I think, Mahesh, the return of FPIs is something that everyone is eyeing. Though the DIIs have been fair and enough to support markets to some extent, how are you seeing the positioning currently? Because it is low in terms of how much they hold. What are the triggers from a global and domestic market perspective that one should look at, which could cause a significant return of FPIs as well to the Indian markets and impact the market dynamics?
Well, Hiral, to be honest with you, I do not think that the FPI flows will change materially or increase materially towards India during this year because see, what has happened is, as I mentioned, I mean, the relative valuation of India have corrected versus the other emerging markets, which is typically the set of investment opportunities that a typical foreign investor looks at. I mean, they evaluate options between India versus Korea versus Taiwan versus China and so on. And some of these other markets are still trading significantly, cheaper as compared to India. And while one might argue that, oh, that was always the case, that was the case 10 years ago, 5 years ago, why are we talking about differential in the valuation today? The reason to talk about the differential in valuation today is that while India is trading at about 60% premium, I mean, India trades at about 21 times on a P multiple basis, which is 60% more than where the rest of the emerging market or the rest of the Asian markets are trading at. But that difference in P multiple is more relevant today because earlier, Indian corporate sector or Indian markets in general were delivering much higher EPS growth, the corporate EPS growth or the profitability growth. But over the last 2 years, and okay, and historically speaking, that premium that India was able to provide, or Indian companies or the Indian stocks were able to provide, was almost to the tune of 6 to 7 percentage points over and above where the rest of the Asian markets were. But for the last 2 years, that difference has become negative, meaning that the corporate EPS growth in India is lower than what we are seeing elsewhere in Taiwan, Korea, China, etc. And even if you look at the forecast here, which is FY27 or CY26, and I did mention in the beginning that we are expecting improvement in the corporate EPS growth in India, while that is on an absolute basis, but on the relative to the other markets, Indian corporate sector EPS growth is still lower, likely to be next year. So therefore, the question clearly in the minds of investors, the foreign investors who have options of investing in other markets, is that why should we pay 60% premium when the corporate EPS growth is somewhat similar? No. So that's the kind of an argument. So I therefore believe that it is difficult. It is kind of difficult to envisage a situation where large foreign flows come into India. What might change that situation, or what might change, what I just said, is that if there were to be like a significant dollar weakening and the global investors move more towards emerging market as an asset class versus the developed world, let's say the US, let's say, uh, the dollar weakens considerably and emerging market as an asset class becomes much more attractive and we see large flows, then India will get its share. Then India will get its share within the emerging markets. Uh, so if that happens, then yes, we will see large FII flows, but otherwise, difficult to see that happening, Hiral.
Okay. Um, Mahesh, so then therefore I again come back to that main question, right? That if the large FI flows are not happening, and God forbid after so many months of consolidation, if the DI flows trickle off a little bit, we don't know that, but what if they do, right? Because their returns not coming in for 12, 13, 14, 15 months, at some point of time people might say enough is enough. I wonder if there is merit to this argument about recovery, or you reckon that your base assumption might be that at least the domestic flows will stay true?
So my expectation is that the domestic flows should remain. They have been very, very supportive all through the last like several years now. And yes, there is a possibility of some weakness going forward. But by and large, given the differentiation in the taxation treatments and so on, equities as an asset class is still, reasonably, attractive. And I would say that, the fact that, many investors are using this SIP, as a way to invest in the equity markets, which is a great, disciplined way of investing. But yes, you cannot rule out a possible weakness in the domestic flows, and that does remain, one of the risks. But then, Neeraj, one of the other compensating factors would also be that Indian market has also been seeing large amount of equity supply, right? We're almost seeing about $7 to $8 billion a month of equity supply, where the corporates are raising money through IPOs and follow-on offerings and promoter blocks and private equity blocks, etc. A lot of that equity supply is also level sensitive. So if for whatever reason the markets were to correct, I think the supply will go down as well. So to that extent, we have a self-adjusting mechanism which will help support. So our base case, Neeraj, is that the market broadly moves sideways, maybe a little bit upwards, as I mentioned, single-digit returns over the next 12 months, but reasonably a large set of ideas to choose from.
Large set of ideas that we could choose from as well. But again, expectations is something that investors will have to narrow down as well. But thank you, Mahesh, so much for joining us on the show. Always a pleasure to speak to you, and looking forward to conversations in and around the budget as well pretty soon, as soon as the announcements come. And 1st of Feb is the date when the budget will be announced. So that's what we should be looking forward to with Mahesh Nandurkar pretty soon.